Everyone wants free money, and in today's video I'm going to show you what I consider to be the closest thing to free money in the stock market, and that is by selling options. Now look, I know you might be skeptical, and so was I before I learned this strategy, but by the time you finish watching this video, you'll have everything that you need to start making passive income right away. Ladies and gentlemen, welcome back to Pandrea Finance. My name is Alex Pandrea, and in today's video I'm going to show you my strategy for selling options for passive income, how I enter trades, which strike prices I choose, and more importantly, how I close out of my trades to continuously collect that income on a weekly or monthly basis. Now, at the end of this video, I am going to share with you my exact step-by-step game plan that I follow whenever I sell options. So if you're ready, then so am I. Let's just jump into it. The first thing that you need to understand is the difference between buying options and selling options, and what our goal is for each. Now, I know you might know the general difference, but there is one specific piece of information that we must understand before making any trades, and that is that buying and selling options are opposites. Wow. Great observation there, Alex. All right, just hear me out because this is important for the overall strategy. When you buy options, you pay a premium for that option. When you sell options, you're collecting a premium. The money goes from the buyer of the option to the seller of the option. Since both the buyer and seller are betting on the same option, only one can win the trade. As in, the option can either expire in the money or out of the money. The buyer is hoping that the option expires in the money, and the seller is betting that the option expires out of the money. This is in essence the ultimate goal of buying and selling options, and you make profit along the way as that goal becomes a reality in the markets. But here's the interesting part. The percentages of winners between buyers of options and sellers are not equal. The reason for this is that 90% of the out-of-the-money options expire worthless. Now, this statistic doesn't take into account things like closing the options early, taking profits along the way, exercising the options, but nevertheless, the point is you have a way higher percentage of winning your trades if you are on the side of selling options rather than buying options. Because, well, math. So if you have always tried buying options and you see you're losing money, well, that premium that you paid goes to the option seller, who's just collecting that free money basically and laughing all the way to the bank. Counting his. All right, let's jump into the option chain and take a look at an example. We're gonna go ahead and take a look at Facebook, or as it's now known, Meta platforms. We're gonna go ahead, click trade and trade options, and let's go about a month or so out. So I'm gonna choose the expiration date of December 17th and make sure you're on sell and call at the top. You'll notice that the closest at the money strike price, the $345 calls, has a 69% chance of profit. In other words, it has a 69% chance of expiring out of the money. Remember, that is what we want when we're selling options. And 69 is good, but we can do a little bit better. So let's scroll up a little bit and let's go to the $365 calls, which have an 80% chance of expiring out of the money. This translates to 8 out of 10 times you will win this trade if you sell this option. This also means that if you are on the other side of this trade buying the option, you will only win 2 out of 10 times, or 20%, which is the opposite of 80%. Now, Robinhood is sneaky because they don't give you the percentage when you click on buy and call, if you notice over here. So if we switch it to buy and call, you'll see that instead of the percentage of profit, you'll get the to break even price. Because let's be honest, if people see that they only have a 10 to 20% chance of winning the trade, then people might wise up and realize they're just throwing money away. But for you guys, if you want to know the percentage, just know it's the opposite of what the sell call percentage shows. So the key takeaways from this first section are as follows. When selling options, you want the option to expire out of the money. Second, the majority of out of the money options expire worthless, so the math is in our favor when selling options. And third, you have the percentage of winning that trade clearly listed on your brokerage for selling options. So you know mathematically your chance of success. And all of this is great because it takes the guesswork out of options and trading. We're going to follow the numbers, follow the percentage, and we will be successful. Moving on to the second part of this strategy, the different ways that you can make money selling options. Selling options can be broken up into 2 categories basically, selling puts and selling calls. And of course, there's a combination of these two with spreads and iron condors and fancy stuff like that. But basically, you're either selling a call or you're selling a put. So let's go over what it means for each of these categories. Selling puts. Selling puts gives the seller the obligation to purchase stock at a given strike price if that option expires in the money and the option is exercised. If we want to sell options for income, we do not want our stock price to drop below our strike price. If that happens, we may be forced to buy 100 shares of the company for every one option contract we sold. We must have collateral in the form of cash to cover our position in case we are forced to buy the stock. If the stock price does not drop below our strike price, then we get to collect the entire premium. Selling calls. Selling calls gives the seller the obligation to sell stock at a given strike price if that option expires in the money and the option is exercised. If we want to sell calls for income, we do not want our stock price to exceed our strike price. If that happens, we may be forced to sell 100 shares of the company for every one option contract that we sold. To cover our position, we must have collateral in the form of shares, 100 shares for each option contract. If the stock price does not exceed the strike price by expiration, then we get to keep the entire premium. So, to summarize the process of selling calls and puts, the first thing that you do is make sure that you have collateral necessary to start selling options. Okay, so you have the collateral, good. Then you have to pick an option you want to sell and, well, sell it. Once you sell the option, you can collect the premium, cha-ching, and that money is then put into your account right away. That money is now yours to do with what you want. But keep in mind, you'll need to close out your position by buying back that contract at some point. The best case scenario is, of course, the option will expire worthless, as in the premium is now $0 and you don't have to buy it back anymore. But in a lot of cases, you might have the option be worth pennies, so not quite zero, and you don't want to wait until expiration, so you'll decide to buy back that option at a lower price than what you sold it for and keep the difference in profit. Remember, when buying options, we want to buy low and sell high, right? But when selling options, we want to do the opposite, sell high and then buy low. So our ultimate goal when selling options should be to get the most amount of premium possible for that option and then watch that option decrease in value. As that option decreases in value, that means that you will end up keeping more and more of that premium that you collected at the start. Once you close your position, you can go ahead and put a new trade on and do this over and over, collecting premium each week, each month, and he'll be the one this time laughing and also laughing at your past self who used to buy options, never making any money. Okay, now putting it all together, let's take a look back at the option chain and see how much money we can really make selling options. Before we do, it's important to keep one thing in mind and to understand that this is a percentage game, and the money that you're going to make is going to be in percentage terms relative to how much collateral you have to put up. So we always want to take a look at the return on collateral to determine if a trade is a good trade or you can live without it. Typically, I look to make around 2, 3, 4% per month on the money that I have as collateral for selling puts, calls, spreads, all that kind of stuff. And from my personal experience, it usually averages to around 2% return per month overall, which I think is a great return. Remember, the average stock market return is 10% per year, so if we can beat that overall by making an average of 2% monthly, as consistent as possible, what more can you ask for? Now look, if you're here thinking that you can just double your money overnight or have unrealistic expectations of your returns in this market, then I hate to be the one to tell you this, but it just isn't realistic. Especially at the win rates that we're going to have when selling options. Of course, you can make much higher returns by taking way more risk, but then you are not having a disciplined strategy that can consistently make you gains. So if you want to do things correctly and safely without losing all your money, then in my opinion, shoot for 2% per month. And I think overall in the long run, it'll be a much wiser decision. For our first example, let's take a look at Gap. We're going to hit trade options and go about a month out. So let's choose December 17th and make sure you're on what you want to sell. So sell call or sell put. Now for me, I don't own 100 shares of Gap, but I do have cash. So we're going to be selling puts. So make sure you click sell put. And we're going to go down to, let's say, the $22 put, which has a 76% chance of profit. We're going to go ahead and click on the option and enter one contract, and you'll see that we're going to get a minimum credit of $72. And then if we hit review, it'll show you the collateral that you have to put up to receive the $72. In this case, it's $2,200. $200 that you have to put up as collateral in cash for that $72 to be put into your account. And if we do the math on it, $72 is about a 3.5% return on your collateral, which in the context of an individual trade is very good. So you're gonna put up the money, grab 3.5%, try to collect as much premium out of that as possible. If the option decreases in value, you can buy it back and hopefully end up with an average of a 2% return. Second example, let's go to MGM Resorts, hit trade options. And again, we're gonna use the same expiration date of December 17th. And let's check out what we have for sell and put. Make sure all the time that you're on the right thing on the top, because the last thing that you wanna do is buy the option instead of selling it. That would be, We're gonna go down on the option chain after we click sell put. We're gonna go down to about the $47 put, and you can see that we have a 74% chance of profit. So we're gonna click on that option and we're gonna enter one contract, and we see that we get a minimum credit, the premium that we receive, of $129. Now, if we click review, you'll see that we'll have to post collateral of $4,700, and $129 of $4,700 in percentage term is about a 2.5, something like that, between 2.5 and 3% return. Not as good as the gap premium return, but still pretty good. Now, of course, this goes to show you that different stocks have different option premiums. Some premiums may be higher based off of implied volatility and other factors. If you want to learn more about this and more in depth, you can click on this video here that explains further about option premiums, so you know what to look for when choosing an option with a lot of premium baked into it. Speaking of volatile stocks, let's take a look at the third example, AMC. Let's go trade options, hit the same expiration date, December 17th. Make sure you're on sell and put. Again, if you have cash, sell put. If you have the stock itself and you want to sell covered calls, you sell calls. Let's scroll down in the option chain to, let's get a good percentage. The $31 put has a 75% chance of expiring out of the money, so you have a pretty good chance of winning this trade. We're gonna go and click it and hit one contract, and you'll see that you'll get a minimum credit of $201, and if we hit review, you have to post collateral of $3,100. Now, the return on this trade will be about 6.5% off of your collateral, which is a very good return, and that's because the premium on a stock like AMC is very high. So you collect a lot of premium, you let the value drain out of it, and you collect more than you would, let's say, with the first two examples. Now, you can see that an important trait in selling options is slow and steady. You are not looking to make huge gains, and you won't be screenshotting your returns anytime soon to post them on Wall Street bets, I'm afraid. But what the strategy does allow you to do is mathematically guarantee a percentage return to some degree and make a steady income off of the capital and the collateral that you have without putting it at a lot of risk like you might do with other investments. Now, of course, when starting out with a small account, you're going to be making a small percentage on an already small amount, and it might not seem like a lot to begin with. But just like any good compound investment, it grows over time. So the goal is to collect premium slowly but surely, add that premium to your capital, and then the next time you make a 2% return, that dollar amount would be higher because you're making that return on a higher amount. And that snowballs on. And that is how I started. See, for me, I have a separate long-term account that I sell options in. So I do a combination of selling covered calls on the stock that I own, selling puts on the cash that I have, and different things like fancy iron condors and spreads, and I grew that account to now about $1 million. And like I said, I can average about 2% monthly selling options, which is about $5,000 per week, give or take. Again, some weeks are higher, some weeks are lower. Sometimes when a trade is going against me, I might just close it out so I don't get assigned or have to buy shares. But on average, this is how I make passive income on my long-term stock portfolio. Now look, I don't do this to show off my gains to you, because in all honesty, 2% might not even be impressive to some of you out there, but rather to show you that eventually, when your portfolio is at a decent size, you can start making really good income just by selling options. And it sure beats a 4% return a year on your dividend stocks if you're one of those dividend investors. Now here comes the most important part of selling options, and that's closing the position and buying back the option for profit. Now, as you know, our ideal scenario is to have the option expire worthless at expiration. This way we collect 100% of that premium. But is that really the ideal scenario? Well, let's think about this for a second. Let's say you sell an option expiring 1 month out and you collect the full premium, boom, it's in your account right away. Now you want to hold on to that premium and not have to give it back. That's the ultimate goal. But let's say next week that option loses 50% of its value. Well, in that case, what I would do is buy back that option and only keep 50% of the value and then open up a new position rather than having to wait another 3 weeks for the other 50% of that premium, right? Makes sense. I mean, typically the old saying holds true. Profit is profit, and when the option loses value fast, then there is no harm taking profit and moving on to the next trade. This is typically why I don't sell weekly options. See, weekly options don't have a lot of time value in the premium, so you're already starting out not collecting much. The option doesn't lose a lot of value until the last day or so you're having to wait until the last day or the day of expiration to see whether or not the option will expire in the money or out of the money. I personally like monthly options much more because you can collect more premium. I can then close my positions early if necessary at 50% profit, 60, 70% if they lose value quickly, and then turn around and open up a new trade rather than having to wait until expiration to get the rest of that premium. This ultimately will make you more profit in the long run. So here is my strategy put together in a step-by-step formula. You want to pick options that will give you a probability of success of 75% or higher. Now, typically a 1 standard deviation move will put you at around 84% chance of profit. Now, I broke down why you should be looking at standard deviation moves in one of my previous videos, so you can click here to watch that and go over it step by step. But studies have shown that around 75% is that perfect sweet spot for collecting a good premium and having a good chance of success in the trade. And based off of my experience, 75%, 80% works for me. You want to pick an option that will return 2 to 5% on your capital, on your collateral that you put up on a monthly basis. By picking stocks that have higher premium, you'll get those 3, 4, 5% returns, or even higher sometimes. And when closing out your positions at 50% even, you can easily average that 2% goal every month. At least that's what I try to do. Now, studies have shown that about 30 to 45 days out until expiration is the best to sell options. So I would look to go about 45 days out and start closing the position a week or 2 early, depending on how much value that premium has lost. So I would close the position and then open up a new one. After closing the position, I open up a new one so I don't have to wait the full 45 days until expiration. I start closing my positions at about 50% profit. If the value of the premium decreases by 50%, I start buying back the option. At 50%, 60%, 75%, and typically at around 75%, I'm out of the option completely. Now, this of course depends on how quickly you got to that 50 to 75% range, how much time is left on the contract, but I rarely let the option expire worthless because I don't want to wait and I want to get that collateral back and move on to the next trade. So small gains, boom, 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 don't get too greedy and repeat the process. So the key to this is not to just do it once or twice, but to do this repeatedly as many times as possible, making small profits each time. Have patience and be persistent. Nothing great ever came easily, and even though that, yes, in my opinion, this is the closest thing to free money and it is relatively easy, you still have to know as much as possible about what you're doing to be great at it. You can continue your journey learning options by watching my other videos on options here and here. And if you've learned something in this video, I would really appreciate just a little like on that video, just a little tap. And please subscribe if you haven't already because there is a lot more content to come. Thank you so much for watching and we will see you on the next video.